In Lagos, Nigeria, a street vendor just bypassed the central bank to secure a loan using nothing but a smartphone. This isn't just technology, it is the systematic dismantling of traditional banking control across the developing world. While financial experts look the other way, this silent infrastructure is already moving more capital than several national central banks combined. The barrier is crumbling, and the method causing this shift is something most of the world hasn't even noticed yet. It. Think about the last time you walked into a bank. You filled out forms, showed identification, and maybe waited for a week for approval. Now, imagine doing that in a country where the nearest bank branch is a 6 hour bus ride away, or where your local currency loses 10% of its value every single month due to hyperinflation. For roughly 1.4 billion people globally, this is not a hypothetical scenario. It is their reality. Traditional banking models rely on physical infrastructure, brick and mortar branches, and a stable regulatory environment. In places like Nigeria, Argentina, or Vietnam, that system simply fails to scale. That is where digital assets enter the picture, not just as speculative investments for tech bros, but as essential survival tools for families trying to protect their hard earned money. Let's start with the first way crypto is changing everything: the shift toward decentralized remittances. For millions of migrant workers sending money back to their families, the current banking system is a tax on poverty. If you work in the UK and want to send $500 to a relative in rural Kenya using traditional wire transfers, you might lose 10% to service fees, exchange rates, and middleman banks. That is $50 gone just for the act of transferring your own money. Now, look at how the shift is happening by using stablecoins, digital tokens pegged to the US dollar. Workers can bypass the entire legacy network. The transaction cost drops from $50 to less than 50 cents. In some cases, the transfer happens instantly, regardless of the time of day or whether it is a holiday. I remember talking to a man named David who works in construction in Dubai. He used to send money to his family in the Philippines through high street money transfer operators. He told me that for every 4 hours of overtime he worked, the bank took almost all of that extra money just to move the rest of his paycheck home. Once he switched to a digital wallet, he wasn't just saving money. He was ensuring his family had enough to cover food and school tuition every single month. It is a simple shift, but it has profound effects on the local economy. When that money hits their digital wallet, they can spend it locally, save it without fear of local currency collapse, or use it for micro purchases. This isn't theoretical. It is happening today. Okay, that is the easy win. It helps people keep more of what they earn. But here is where it gets interesting, and where we move into the second method: banking the unbanked through mobile first digital identity. In many developing countries, the biggest hurdle to financial inclusion isn't lack of interest, it is a lack of documentation. Without a government issued identity, you cannot open a bank account. Without an account, you cannot access credit or insurance. It is a vicious cycle. Consider the example of the WWF and UNHCR, projects using blockchain for identity verification. By creating a self-sovereign digital identity on a ledger, an individual can prove who they are and track their transaction history without needing a state bank to vouch for them. Imagine a refugee arriving in a new country with nothing but a phone. If their credentials and financial history are tied to a secure, decentralized network, they can immediately access basic financial services. This solves the trust problem. Banks don't lend because they can't verify risk. If you have a verifiable, tamper-proof history of utility payments, work history, and digital transactions on a ledger, a smart contract can approve a microloan in seconds. A report from the World Bank in 2022 suggested that digital ID is the single most important factor in bringing the unbanked into the global financial fold. If this is clicking for you, hit subscribe. I drop videos like this every week to help you understand the shifting economic landscape. All right, ready for the one I've been saving? This is the third method, and it is the one most people overlook: decentralized finance, or DeFi, as a hedge against sovereign instability. This is the big one. In countries like Argentina, where inflation reached over 100% in 2023, the local currency is effectively a melting ice cube. If you hold it, you lose. If you don't convert it into something stable, your purchasing power evaporates before the end of the month. Most people in these regions have turned to informal blue dollar markets or bought black market US dollars just to survive. But crypto DeFi protocols provide an automated, accessible alternative. People are now depositing their earnings into liquidity pools that earn interest in digital assets pegged to the dollar. It functions like a high-yield savings account, but without the gatekeepers. Think about the sheer scale. According to Chainalysis, some of the highest rates of grassroots cryptocurrency adoption in the world are in Vietnam, the Philippines, and Nigeria. These people aren't day trading for a Lambo. They're using decentralized platforms to protect their life savings from hyperinflation. They are essentially creating their own parallel banking system that is immune to local political whims. And here's the kicker: because it is all on an open source protocol. Nobody can turn it off. If a government decides to freeze bank accounts to stop capital flight, they cannot touch the money sitting in a user's private key protected wallet. That one shift alone changes the power dynamic between the citizen and the state. Once you see the economy as a tool that can be owned and managed by the people using it, you can't unsee it. So, we have covered the speed of low-cost remittances, the power of digital identity, and the security of decentralized inflation hedges. Each of these is a pillar that, when combined, offers a way for millions of people to escape the limitations of a broken banking system. The world is becoming more interconnected, and the tools we use to store and move value are evolving faster than our traditional institutions can keep up with. It isn't just about the technology. It's about the democratization of opportunity. If you got value from this, share it with someone who needs to hear it and subscribe so you don't miss the next one. I've got something even better coming next week. We are looking at how AI is about to change the way we manage our personal taxes. You don't want to miss that. Take care, and I will see you in the next one.